Joining us now is Mervin Jebaraj, Director of the Center for Business and Economic Research at the Walton College of Business at the University of Arkansas. Mervin, always good to be with you. Let's begin with some Arkansas unemployment numbers. We've seen consistently that the state of Arkansas has unemployment under 4%. I think it's been about 32 months in a row. Tell me what you are seeing in terms of this trend, and what are problems with the labor force participation rate?
Absolutely. You mentioned 32 months of the unemployment rate being below 4%. You know, we're talking about this as for the age of a baby in months here. So that's how, not long this recovery, at least the good part of this recovery, has been here in Arkansas and for the nation as a whole, too. So with the unemployment rate this low, the one positive that we've seen from all of it is that wages have finally gone up for workers. In the last 2 years, we've averaged about 2% wage growth on a year-over-year basis for all private sector workers in Arkansas, adjusted for inflation. So we've taken away the effect of inflation, and they're still making 2% more on a year-over-year basis. And this was in 2017 and all of 2018, too. So that's the really good piece of news from the unemployment rate. You know, it's not just nice to see a low headline unemployment rate. You want to get the positive effects of the low unemployment rate, which would be wage increases for workers across the state. So that's a positive. The other news that hasn't gotten a whole lot of attention that is important as well is that, we've gotten the expected revisions that come every year in March. And this year, the revisions are a lot more significant than they usually were in previous years from the BLS. And what that has done is it has made the labor force decline not as bad in 2018 in Arkansas. So previously, before the revisions, we were looking at going from a 1% labor force growth rate to about -1%. So a large swing in the labor force growth rate in Arkansas. After the revisions, we went from about from positive 1% labor force growth rate to about just under 0% labor force growth rate. So still the labor force overall did decline in Arkansas, but the decline wasn't as steep as we thought it was. And this, goes through the metro areas as well as the non-metro areas too. And so combined with that, the revisions that we got on the employment side and the payroll side of the employment show that Arkansas not only added jobs in the metro areas of Northwest Arkansas, Central Arkansas, and Jonesboro, but some of the other metro areas added a few jobs. And the rural areas added a few thousand jobs and didn't lose as many jobs as we thought they did before the revision. So all in all, it made 2018's employment outlook in Arkansas match the federal employment numbers that we've been seeing. So the rest of the country's economies tended to be doing a lot better than Arkansas seemed to be in 2018, and it looks like we mirrored that a lot closer than we were thinking all of 2018, and that is positive news. Now, just because the labor force growth rate declined a little less than we thought it did, doesn't mean that it's necessarily positive. We still have one of the lowest labor force participation rates in the country. A lot of that is driven by opioid addiction, and we still haven't done anything to improve our labor force participation rate, which stands just under 58% here in Arkansas, and that number really needs to improve to well over 60%.
Let's talk about what's happening at the national level. The Federal Reserve Bank declared that they don't expect any interest rate hikes this year. Tell me, why would they make that statement as early in the year as they did, and what do you think that means?
So they've made a lot of quick changes to their decisions. So in December of 2018, they came out and said that they're going to do 2 more rate increases in 2019. In January, after the markets were roiled after that announcement, they came out and said that, okay, maybe just 1 rate increase in 2019. And now last week we've seen that they came out and readjusted that and said likely absolutely no rate increases in 2019. And I think in large part they think that the U.S. economy is slowing. It doesn't mean that the U.S. economy is headed for a recession, but with the stimulus from the tax cuts that happened at the end of 2017, 2018's growth rate annual average was about 2.9, close to 3%. They think, however, that the 2019 growth rate will drop all the way to about 2.1%, which is significantly slower, as you'd imagine, than 3% growth rate. So that slower U.S. growth rate will not need to see any more rate increases in 2019. In fact, I think depending on who you look at, there are probably odds are even or about 25% chance that the Federal Reserve might actually cut rates in 2019. But we'll have to wait and see. What they've said is that they want to be extremely patient, wait until they need to move on rates before they move on rates. And the one thing that they are looking at is that inflation has stayed stubbornly around 2% or below 2%, which is their target. They were thinking they would get above 2%, but they don't plan to get to 2%. So combined with the U.S. economic slowdown, inflation not getting up to 2%, global economic slowdown with stuff going on in the European Union, Canada is officially on recession watch, China's economy is slowing down as well, and with the Brexit process still unresolved, we don't know what's going to happen in those European sector economies. There's a lot of sort of clouds hanging over the global economy as we wait. So I think the Federal Reserve is going to wait as long as they can before making another decision, but it looks very likely that they're going to stay throughout 2019 without changing rates.
All right, Mervin, I'm going to let you completely nerd out and be a full-blown economist with this last question here. We have heard a lot about yield curve inversion. I want you to tell everybody what yield curve inversion is, and is it really an accurate prediction of what might happen in the near-term future for the economy, or is it just more of a kind of self-fulfilling prophecy?
Well, I think there are a lot of yield curve evangelists out there in the world, and they talk about the yield curve like it is the second coming of Christ, and its predictive powers are amazing. Now, what is true about the yield curve is that it has correctly predicted the last few recessions. That doesn't necessarily mean that it's going to predict every recession in the future. Now, what it is essentially this: there are, short-term bonds and long-term bonds. Long-term bonds in general have higher interest rates because people have to give up their money for longer periods of time. Risk factors are higher over a longer time period. Inflation risks might be higher over a longer time period. So in general, long-term bonds, say 10-year treasuries, have higher yields than short-term bonds, say 3-year or 2-year treasuries. Now, when there is a threat of a recession, this switches over because people expect short-term treasuries to lose value as the Federal Reserve drops its rates because we're headed towards a recession. So people are more willing to get into long-term bonds even though there are low yields. So what this does is it inverts the curve where the difference between the long-term and short-term treasuries turns negative, and that's what we call a yield curve inversion. So in the past, this is, the reason why the yield curve inverts is important. So if the yield curve is inverting because people are fleeing short-term treasuries into long-term treasuries because they think there's a recession, then I think the yield curve inversion works as a good predictor of recessions. But I don't think that that's why long-term treasuries have lower yields. I think long-term treasuries have lower yields for a couple of different reasons. Developed economies across the world are in lower growth cycles, like the United States and the European Union. We're thinking about our long-term growth being closer to about 2%, not higher than that. So that flattens the yield curve as it is, so it makes yield curve inversions a lot more likely. Global inflation expectations, especially inflation expectations here in the United States, are well anchored below 2%. So again, that flattens the yield curve, making yield curve inversions more likely. And the other factor to remember is that the Federal Reserve has a massive balance sheet that they accumulated as part of quantitative easing and some of the other actions they took after the last recession. And what they did was bought up a whole bunch of long-term treasuries, which pushed down their yields. And the Federal Reserve is still holding on to a lot of these long-term treasuries. They have divested some of these treasuries, but they're stopping that process later this year. So that puts negative pressure on yields as well, in the sense that the Federal Reserve holds a lot of treasuries and yields are lower. So for a variety of different reasons, the long-term yields are lower that don't have to do with people fleeing short-term for long-term because of short-term economic prospects. So that's not to say that we're not likely to see a recession next year. It's just to say that maybe the yield curve inversion stops being as good a predictor because of some other structural issues in our economy. How's that for all the nerds out there?